Welcome to Get Rich Education. I'm your host, Keith Weinhold, talking today about how to permanently reduce your greatest expense in life. That's your tax obligation. And we're doing it with a great guest. Limit your tax liability, hopefully to near zero, today on Get Rich Education. Finally, with Total Control Financial, get checkbook control of your existing 401k and IRA funds to invest in real estate. Yes, you can move your retirement money into your own checking account, but you must avoid the little-known tax that you'll get hammered with in a self-directed IRA. Instead, start your QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to fourplexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Chaley Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Albany, New York to Albany, Oregon, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. When you work for someone and they pay you, that's called a job. Well, what does the government do when you work for someone and they pay you? They say, yeah, we'll need to take 30 to 50% of that. That is the income tax. Yeah, that's what your rate can be, federal and state combined. Oh, would you like to spend some of this leftover income that we allowed you to keep? Well, we'll have to charge you an extra 5 to 10% every time that you do that. That is called the sales tax. Oh, you managed to store up enough money to get a little piece of land and a house? Better than paying rent, you say? Well, then you'll need to fork over several $1,000s every year just for the privilege. That is called the property tax. Oh, you invested in a 401k or IRA for what you thought was security and independence in your old age? Well, then we want to thank you for putting your money into our financial casino, which also achieved zero real return after inflation, emotion, volatility, and fees. So we'll unfortunately also have to take 30% of these investment gains as well. That's called the capital gains tax. Well, now there you are, near the end of your life. You have either lived a good life or you haven't, but you made it to the end. You worked hard. You might even have had a little money left over to give to your kids if you're really lucky, but more often than not, you don't have anything significant left. But in the case that you do, the government says, we'll need to take a piece of that as well. It's only fair for the good of society. So rest in peace, but we're taking our inheritance tax. And at what point did you realize that you're in tax servitude for your government overlords? Maybe that point is right now. This substantial slice of every pot of money that you managed to put together throughout your life just keeps getting bitten away and taken away and eaten away. So we're talking about how to permanently reduce your taxes today with Rich Dad Tax Advisor Tom Wheelwright. And the timing is critical because, as you'll see, there are some things that you must do before the year ends if you want some preferential tax treatment. Something else that you need to be mindful of is the fact that, as I like to say, taxation is not adjusted for inflation. So what do I mean by that? Well, say that your new $100 investment that you made 1 year ago went up to $105 over this past year, and so you sell it, and therefore that $5 gain that you realize is subject to a long-term capital gains tax. Well, during that year, if the real, not the government reported, but the real rate of inflation was also 5%, then your $100 investment going up to $105 in value, that means that you have the same amount of prosperity that you began with when you bought the investment 1 year ago. But see, yet you're taxed on that 5%, even though that's what it took just to keep up with inflation. So in this case, even though you had a 5% paper gain, your prosperity was just diminished. That is because taxation is not adjusted for inflation. When you realize that, on top of everything else, it can give you an uber motivation for learning about how to reduce your tax burden. I hope you've been enjoying the holidays. Maybe one of the more interesting things that I can tell you that I attempted during the holidays is that a few weeks ago, I made Thanksgiving Day an intentional digital-free day. Perhaps you've heard of others regularly taking a digital-free day to connect with the real things in life. Yes, that's right. On Wednesday night, I put my phone in a drawer, and I didn't get it out and look at it again until the following Friday morning. No computers, laptops, or tablets either. Well, I survived, but it was inconvenient. Now, luckily on Thanksgiving, you're usually interacting with more people than usual, but still, I couldn't use my phone's workout timer for exercising in the morning. I couldn't take photos of anything. No checking email or texts. To compound things, the weather was even lousy, so I couldn't do anything outdoors on my digital-free day either. Having NFL football on TV really saved me, but during the commercials, I couldn't scan social media. But just think about it. When's the last day of your life, just any one day, that you didn't even look at your phone just once? Your answer might be more than 10 years ago. Well, for me, the answer is now, a few Thursdays ago. I'd say that my big takeaway from my digital-free day was that we're really dependent on our phones in everyday life. But my other takeaway is really, so what? I already knew that we're dependent on them, so I don't really think that I learned much of anything from this day of great inconvenience. Who knows? Maybe I would have had some great epiphany if the weather were fair and I did something great outdoors phone-free. So the digital-free day, I don't know that it's anything that you need to try. Now, when we talk about permanently reducing your taxes today, as often happens, it is a United States-centric episode. It's going to be most useful if you're an American citizen. And if you're in one of our other 187 listener nations today, this is more of a general guide than it is a specific roadmap to tax relief like it is for Americans. That's because, in general, most world governments provide tax incentives to you when you provide others in society with things like jobs, housing, energy, and sometimes food. Now that the still fairly new Tax Cuts and Jobs Act has been effective for a couple years, we do better understand it. So we're going to look at how people are optimizing it to reduce their taxes. Today's guest is a regular contributor here at Get Rich Education. He helps people like you permanently reduce their taxes. I'd like to welcome who is a familiar guest here at Get Rich Education. He's a CPA and author. He's the founder and CEO of Wealth Ability. Welcome back to the show, Tom Wheelwright.
Hey, thanks for having me, Keith. Always good to be on your show.
Oh, it's so great to have you back. You bring so much energy to taxes. The Tax Cuts and Jobs Act of 2017, that was some sweeping reform. That was passed into law December of 2017, so it's just a couple years old. You might also hear people refer to this colloquially as the Trump tax cuts, the most sweeping tax legislation that we've had since the tax reform of 1986. And there really are a lot of overlooked and misunderstood deductions with the Tax Cuts and Jobs Act and some things that people can really optimize as we're here near year end, especially. But before we get into that, I just want to drop back and let people know what a tax deduction is. A tax deduction, that's the amount by which your taxable income is reduced. So if you get a $5,000 deduction somewhere and you made, say, $150,000 in income this year, well, rather than paying tax on $150K, you'd pay the tax rate on $145K of your income. So it's not a $5,000 savings like a tax credit would be, but it's a $5,000 deduction And there are myriad tax deductions out there, which is good news. There are myriad ways to reduce your taxable income. So tell us about some of those, Tom, especially those ones with the Tax Cuts and Jobs Act. I think one of it starts off, whether you're a real estate investor or not, is with the SALT deduction limit, the state and local tax deduction limit. Tell us about that.
Let's back up just a second because I like your introduction on the deduction.
Yeah.
Remember that we're technically a net income tax country, right? It's a tax on net income, not on gross income. Whereas sales tax is typically a tax on gross income, income tax tends to be a tax on net income. What's interesting, though, is with this new tax law, we've really become a tax on consumption. And, we think of tax on consumption typically as like a value-added tax or a sales tax. That's a tax on consumption. But when you think about what happened with this Tax Cuts and Jobs Act is now we've always thought with the deduction, if you take your money that you earn and you put it someplace the government wants it to be put and they give you a deduction for that, then that income's not really taxed. So let's say that you earn of your $140,000 that you earned, $5,000 goes someplace the government wants it to go, and therefore the government reduces the amount that's taxed on that 140 from 140 to 135. That's really what's going on, is that you're just doing something the government wants done, and therefore they reduce the amount that's being taxed. Well, anybody who's in real estate investing, for example, is really in the business of real estate investing. And business has long known that if you take income and you put it back into the business, it's a deduction, so therefore it's not taxable.
Yeah.
So what happened with this act, though, was that the act went a step further towards a consumption tax and said, not only are we going to give you a tax benefit if you put it back into operating expenses of your business, we're actually going to give you a deduction if you put it back into assets of your business. So, for example, if you're a business owner and let's say you're a manufacturer and you put that money that you earn into equipment, that equipment now is fully deductible in the year that you buy it, whether it's new or used. Therefore, you're not taxed on that income. If, on the other hand, you take that money out and spend it for personal purposes and consume it, now it's taxable. The same is true in real estate, which is the first time ever in the history of the U.S. and from what I know, it's really in the history period of the world, that you could take money now. Let's say you took $100,000 and you earned $100,000 of income, and then you took that and you bought real estate with it, and you put $100,000 down, and then you borrowed $400,000, so that now you have a $500,000 asset. Well, that $500,000 asset is going to produce an immediate deduction of at least $100,000 and probably more than that. That's called bonus depreciation. So what's happening is you're taking your money, you're putting it into an asset that's a business asset, in this case, real estate business, and you don't get taxed on that money. So the only time you're going to get taxed, the same is true with, for example, with oil and gas. If you take that money and put it into a producing oil and gas well or an intended producing oil and gas well, then that money is deducted and you're not paying tax on that income. So that's kind of the idea. If you think about this new tax law, what it's really done is said, look, the more assets I buy, the less tax I pay. And that's really the first time in history that we've really had this kind of a major tax reduction for assets, not just for operating expenses. So if you look at bonus depreciation, that's a big one because y'all know it applies not only to new property, but it actually applies to used property, and it applies to both commercial and residential property. And the reason it applies is because what the law says is anything that has a useful life of less than 20 years gets to be deducted the year we put it into service, the year we buy it and put it into service.
Rather than slowly depreciated over time.
Instead of slowly depreciated over time. So, for example, a building, a commercial building or industrial building typically is, they say, is going to wear out over 39 years, so about 2.5% a year. Residential, they say, well, that wears out faster. You have people living there, so it's really 3.6% a year. What they're saying, though, is that landscaping, land improvements, wall coverings, ceiling fans, flooring, things like that, cabinetry, they really don't aren't going to last that long. And what we're going to do is we're going to say, look, you get a deduction currently the year you place in service, even if it's used property. So you can go out and buy used Aplex, okay, and you still get this deduction, even though the person before you also took a depreciation deduction.
That's remarkable.
And it's unbelievable. And in fact, they might have deferred theirs through a 1031. You still get the full advantage of it. So basically, you're multiplying the depreciation over and over and over again. And you actually can do this over and over and over again. That's, to me, the big difference between the 2017 law and the 1986 law, which is when I was back in Washington in 1986. In 1986, real estate was the big loser. In 2017, real estate's the big winner.
Right. That's what you get, like him or not, when you have a real estate investor president in the White House.
That's what you get. Exactly.
So it really incentivizes people to invest rather than consume.
That's what this whole law is about. And I've not heard anybody else talking about it that way. It's really about if you consume, you're going to pay tax. Now, go to the SALT deduction. What is the SALT deduction? State and local taxes. That's what SALT stands for. And this is actually, state and local taxes is what the course that I created and taught for 14 years at Arizona State University in their Masters of Tax program. The SALT deduction is a deduction, either real estate or income tax, for state taxes you pay, whether real estate taxes or income taxes. And the reality is, this is all consumption. If you're paying state income taxes, what you're doing is you're consuming the goods and services of the state government, and that's what you're paying for.
Right.
If it's real estate, it's for your own home mortgage or some type of real estate that you're consuming. In other words, you're using personally as opposed to creating assets for somebody else. And because of that consumption, what they said was, look, the state and local tax, we're going to limit that. We're going to limit it to $10,000. And what, of course, who it hurts is the states that are not efficient in their government. It hurts those states like New York and New Jersey,
Connecticut, California,
those states, because what was happening is people like in your state, in Alaska, that, I mean, you guys have zero, no tax, and you're subsidizing basically all these heavy taxes in these other states. What Congress said is look, we're not going to make the states who are more efficient subsidize the less efficient states. That's really what it was.
So it's now a cap of a $10,000 deduction. You cannot take a deduction of more than $10,000 on your state and local property tax. So therefore, people in higher real estate cost and high tax markets, oftentimes those ones on the coast, are the ones that are penalized the most because it's those taxpayers that can only take up to a $10,000 deduction. And
right.
Some people in lower cost states, they might only have $6,000 or whatever to deduct. So it really doesn't affect them.
Remember, Keith, that this is only your personal residence we're talking about.
Right.
If you have investment real estate, you can take real estate taxes as much as they are. I mean, if you've got an apartment complex and you've got a $100,000 real estate tax bill, you still get to deduct the $100,000. This only applies to the consumers. It doesn't apply to the producers. Only the consumers, not the producers. So that's a very important distinction. And by the way, the same thing on the home mortgage interest. I had people ask me, well, wait a minute, there's this now limitation on up to $750,000 of a mortgage, right? For purchase price of this home, $750,000. Okay, yes, but that's not true if it's investment real estate. If it's investment real estate, you can take it up to millions and hundreds of millions of dollars. So there's no limitation on the producers, only on the consumers.
And I should also add that we're only talking about consumers that itemize their taxes here.
That's true.
The standard deduction for this year is $12,200 for a single filer, $24,400 for those that are married filing jointly. So we're not talking about real estate investing so much at all, really, with this SALT deduction. But let's talk more about those income properties when we come back and what the Tax Cuts and Jobs Act is doing for you. You're listening to Get Rich Education. Our guest is Tom Wheelwright. More when we come back. I'm your host, Keith Weinhold.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.
Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com.
This is Entrepreneur on Fire's John Lee Dumas. Don't follow money, make money follow you with Get Rich Education.
Welcome back to Get Rich Education. We're talking with Rich Dad Advisor Tom Wheelwright. Check out his website at wealthability.com. Tom, tell us more about these changes, which are still relatively new in the Tax Cuts and Jobs Act, also known as the Trump Tax Act, especially with the 20% pass-through deduction. What is that, and how does one optimize it?
Well, let me tell you why that's important, Keith. Remember, now we're getting this big bonus depreciation in the first year. Well, what that means is that after year one, you're probably going to have taxable income from your real estate. So Congress, in the great giveaway to real estate, said, look, the first year you're going to get this big bonus depreciation deduction. The second year, now you're going to have income, which you wouldn't have before because you had depreciation every year, right? But now you're going to have a little tiny bit of depreciation the second year. Now you're going to have income. We're only going to tax you on 80% of that income. So you get a deduction against 100% of your income for depreciation, but when that income now is taxed, we're only going to tax you on 80% of it. That's this 20% deduction. And so people think, historically, we haven't ever had, if you use leverage for your real estate, we really haven't ever had any taxable income. Now you may, because if, let's say you buy a big piece of real estate one year, but the next year you don't, you can't find the right piece of real estate, whatever, and you actually don't end up buying a big piece of real estate the next year, then what you have is you're going to have net taxable income from that. Good news is you only have to pay tax on 80% of it. Now, there's all sorts of limitations, rules, etc. Just know that for most real estate, if you have net income from that real estate from a tax standpoint, you are going to only pay tax on 80%.
That's the 20% pass-through deduction. For those that don't understand pass-through, tell us about that part.
I rarely give an absolute. This is a case where it's as close to an absolute as you're going to get from me. And that is, you should never, ever own investment real estate in a C corporation. And a C corporation is a corporation that pays its own taxes. And the reason is because if you ever have to take that real estate out for any reason, like refinancing, for example, that's a taxable event in a C corporation. So what we typically do is we typically hold real estate either in a single member LLC, which is called a disregarded entity, or in a multi-member LLC that's taxed as a partnership. Those are both pass-through entities, meaning that the entity doesn't pay the tax, the owners pay the tax. It also means that the entity doesn't get the tax breaks, the owners get the tax breaks. When you talk about you earn $135,000 and you get a $140,000 deduction, let's say you earn that $140,000 in your job or your business, and then you get this $5,000 deduction for real estate because it's your net loss is $5,000. You can use that because it passes through to you personally, and you can use that $5,000 of loss against your $140,000 of income. Now, before anybody starts sending us letters, we'll talk on another time about the real estate professional and how to use those losses. Yeah. Just know that those losses can be available to you if you have the right tax advice.
A pass-through tax deduction. That tax treatment passes through the entity to the individual.
Correct.
There were some other good incentives in the Tax Cuts and Jobs Act that were really advantageous for real estate investors. One of those is Section 179 for rental property. Tell us about optimizing that. I think this is one that has to do with vacation property.
Yes, it can. I'll tell you, 179, where it really got beneficial, though, is commercial property, not residential property, because 179 generally does not apply to residential property. So your long-term residential rentals doesn't apply to. But for commercial property, it does apply. And 179 is very much like bonus depreciation. Don't worry, you're going to take bonus depreciation anyway, because most of the time bonus depreciation is better than Section 179. 179 merely says it's a separate code section. So bonus depreciation is Section 1668K, and 179 is its own code section. Basically what it says is certain equipment can be deducted in the year you buy it, fully deducted. Now, what's some of that equipment? Well, some of that equipment now includes a brand new roof, includes HVAC units, it includes security alarms and fire alarms. So these are things that before were always considered to be part of the building, and you had to deduct over 39 years.
Right.
Now you get to deduct them the year you buy them and put them in service. So that 179 deduction for commercial property is particularly important because it applies to commercial property, and we have extra things we can take that aren't bonus depreciation. Anything we can take bonus depreciation, we're normally going to take bonus depreciation because it's slightly better than 179. But those 4 items we don't get bonus depreciation on, so we're going to take 179.
Now, a lot of the deductions that we've talked about so far pertain to reducing one's taxable income, but there's another way to maximize your tax savings. And then, Tom, part of the Tax Cuts and Jobs Act is the fairly, I'll say, celebrated Opportunity Zone. Tell us about that and the advantages that roll in with the Opportunity Zone.
So we're learning more and more about Opportunity Zones, and more people are doing it. There's some great tax benefits and something we really need to think about before the end of the year. So there are really 3 primary tax benefits to the Opportunity Zone. First of all, an Opportunity Zone property is a property that is in a distressed area that is designated by the state as an Opportunity Zone, certified by the government. So you can actually go in your search engine and Google or search Opportunity Zones, and it will actually tell you where the Opportunity Zones are in your area or where you're investing. And so it's a particular area, and it just requires major redevelopment. So in other words, you actually have to significantly improve the property. You can't just go out and buy it and do a couple repairs. You have to significantly improve it. What happens is, though, if you use an Opportunity Zone, is there's really 3 major tax benefits. The first is what we call deferral, which means any capital gain, it doesn't matter if it's real estate, stocks, a business, any capital gain can be deferred for up till 2026. So you got this 7-year deferral from now. It's going to be deferred, meaning it's postponed. So you don't have to pick it up in tax until the end of 2026. Now, here's the great thing. The second one is if you hold the property for 5 years, then you get a 10% exclusion of that deferred gain. So you're only going to be taxed on 90% of it. And if you hold it an extra 2 years, so 7 years total, you get to wipe off 15%. So here's where this is important. We're coming up to the end of 2019, and guess what? After 2019, you're not going to have 7 years before 2026. So in order to get the full 15%, you have to do it between now and the end of the year. And I know that's quick, but there are Opportunity Zone investments out there, and they don't have to have actually done all the work yet. In fact, they have 31 months to do the work. So they just have to set up right now, have it available. The fund, by the way, a fund is anybody can create a fund. I can create a fund in 5 minutes, okay, a certified Opportunity Zone fund. And the reason is because you self-certify it. I mean, it's amazing, and it could be an LLC, it can be a partnership, it could be a corporation, though, again, that would be stupid. But you can start an Opportunity Zone fund anytime you want, okay, qualified Opportunity Zone fund. On the other hand, there's a lot of people out there that have already done this, and they are currently looking for investors. So if you have a capital gain, again, unlike a 1031, where you have to roll over the entire sales price, in an opportunity zone, you only have to roll over the actual amount of the gain. So you get to defer the gain, you get to eliminate 15%. And here is, I think, the magic of this. After 10 years, if you hold this property for 10 years, the appreciation from when you first bought it, that appreciation is tax-free. I'm not saying tax deferred. You don't have to do a 1031. It is just simply tax-free. And that's not the deferral portion. It's not the portion of the rollover. It's the actual appreciation from when you bought it until when you sell it 10 plus years down the road. So you have deferral. You have that 15% of the deferral possibly eliminated, and then you can eliminate the appreciation on the property as well. So these are three really big tax benefits, and I think that people are starting to get it now. I have a friend that all he's doing now is opportunity zones. There is literally a lot of opportunity out there.
Yeah, I have a friend that sponsors an opportunity zone fund in my own hometown. So Tom and I have talked about opportunity zones on the show before, but the timing is so key with this, with us only having about 15 days left until the end of the year here. So timing is key. Well, just Tom, overall with what we talked about with the Tax Cuts and Jobs Act, you, the listener, might have heard something here that you think you've missed. And the Tax Cuts and Jobs Act only applied to 2018 taxes for the first time. That's the first tax year that it was effective. So, Tom, if someone heard about an opportunity that they don't think they optimize, can they work with you and with your network of advisors and go back and amend their 2018 taxes?
There may absolutely be opportunities to do that. So our network is the Wealthability Network. We have now 25 accounting firms in our network, and we are growing literally every single day. Our goal is 10,000 CPA firms around the world. So we just continue to add member firms, and they're all trained. I train them. In fact, I'm doing 2 more trainings for them. I'm continually training our network members. So we're just there to help any way we can. We do specialize, do a lot of real estate as one of our specialties. You know, anybody who has a question, wants to go over something, we're happy to help. Just go to wealthability.com, and there's a place that you can click schedule, and you can actually schedule the meeting right then and there. And we're happy to help any way we can. And we don't charge you for asking a quick question, nor do we charge for lining you up with one of our members.
My wife and I's own tax strategy and tax preparation comes through Tom's referral network. Check out wealthability.com. Tom Wheelwright, it's been great having you back on the show.
Good to be here, Keith.
Let's review some of what you learned today. Income tax is a tax on net income. Sales tax is a tax on gross income. That's so simple, but yet it's something that I hadn't thought about before. Business equipment is now fully deductible in the year that you buy it, whether new or used. The same is true in real estate with bonus depreciation. When you convert your income into an asset, bonus depreciation applies to both residential and commercial real estate. Don't own investment real estate in a C corporation. That way, you can get the preferential pass-through tax treatment. Opportunity zones are part of the 2017 Tax Cuts and Jobs Act as well. But it means you have to make a major improvement and double a property's value. That's often not the best thing to do if you're a busy professional, unless perhaps you're investing in someone else's fund. Tom mentioned talking about the real estate professional designation in the future. Yeah, Tom is coming back here on the show in the next few weeks. We're going to do a deep dive on permanently reducing your taxes if you can qualify for that specific real estate professional designation. Also, when Tom returns, Tom has mentioned before here on the show in the past that it often doesn't make sense to contribute to your 401k plan. Even if you get a dollar per dollar match from your employer, you may very well still want to avoid it. And I know for some enlightened real estate investors that have a day job, they might still contribute to the retirement plan just up to the point where you get a dollar per dollar match. And then any investable dollars beyond that do go into real estate. And then some other people, like enlightened real estate investors, don't even participate up to the matching level either. So Tom's got thoughts and energy on this topic. I've got thoughts and energy on this topic as well. That'll be a great chat here that we're going to have down the road. Also, in the next few weeks, we're going to bring a regular Get Rich Education listener, perhaps like you, onto the show, and he's going to tell us about his investment experience and how Get Rich Education has changed his investing mindset. It's more important to increase your income than it is to cut your expenses, sure. But when it comes to paying more in taxes, you don't personally receive any gain from that type of quote unquote spending, if you want to call it that. So for a lot of people, the quickest way to increase your income is to reduce your taxes. Big thanks to our regular contributor, Tom Wheelwright today. You can learn more by starting at wealthability.com. Until next week, when I'll be back to help you build your wealth, I'm Keith Weinhold. Though you might quit your day job, don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.